Hi, and welcome to the X22 Report Spotlight. Today we have a returning guest, Michael Pento. Michael is the president and founder of Pento Portfolio Strategies. That's pentoport.com. And I am very happy to have him back on the X22 Report Spotlight. Michael, welcome back to the Spotlight.
Thank you so much for having me back on, Dave.
Hey, thanks for being here. And I wanted to start off with China, with tariffs. And we know that Trump has been trying to make this deal with China. So far, he has not made a deal, and he says, I'm not really worried about the deal. We also see Trump placing tariffs on many different countries. What do you think his strategy is with tariffs, with putting pressure on other countries? Why is he doing this right now? Aren't the trade deals that we have now okay?
Well, I think he's trying to live up to his campaign promises. I mean, he promised to rebuild the Rust Belt. He sees a lot of erstwhile manufacturing employees now becoming Walmart greeters and Uber and Lyft drivers. So, for me, I'm a free trader, but do we really have free trade around the world when China subsidizes their corporations and steals our intellectual property? I think Trump is going a little bit off the reservation when he tries to conflate tariffs with immigration. I think there's better ways to deal with immigration. So we'll know soon if Trump puts tariffs on Mexico at 5%. If they go up from there, depends on whether or not Mexico attenuates the flow of migrants coming from Central America and Mexico into the United States. So, but the basic idea of trade is, for example, I'm in the United States and I produce a lot of wheat, and you are in Brazil and you produce a lot of, let's just say, steel or copper. You pick a metal. Well, my superfluous amount of wheat can be traded with Brazil's superfluous production of copper, and it benefits everybody. I mean, I'm trading a good, and you're trading a good with me, and I'm trading a good with you. There's no currency distortions, and everybody's better off for it. You improve the quality of life. But if your idea of trade is a bastardization of it, meaning you just print currency and exchange it for goods and services, what you end up doing is selling away your country piece by piece. The ownership of your country gets sold to the country that has the surplus in exports. So you're selling away the country and the future production of that country to the other nation. So it's not a very good idea. I think Trump is trying to rectify our massive trade imbalances, and I'm all for it. I'm not for everything Trump does at all, but I'm for this particular aspect of his agenda.
So what you're saying is he's been, not him, but other presidents, other individuals within government, slowly but surely, and we've seen it, they've been moving manufacturers, corporations, and all of this out of the country. And with these new trade deals, he's trying to bring everything back and reestablish the United States once again.
Well, I think that's his ultimate goal. Trump could have made a superficial deal with China. China could have purchased more soybeans from the United States, and we could have balanced our trade deficit with China in that regard. However, he had an opportunity to do that, but he turned it down. And I have to believe, although I have no insider information about this, although I am friends with some people in the cabinet, I will tell you I have no inside information, but I believe viscerally that Trump wants to make sure that the United States, the US of A, has the premier title of the world's one and only superpower. And he's trying to that's his basic assumption. He wants to make sure that China does not rise above US in the hierarchy of superpowers. So this is probably his real goal, because he could have made a superficial deal with China and he turned that down.
So do you think eventually he's going to make this deal with China?
No. I mean,
So you don't think he's going to make any deal with China at all?
If I used to think he was, and then, first of all, predicting what Donald Trump is going to do was a very, very difficult exercise. But like I said, now it's very difficult to make a deal with China at all in the near term. in the next few quarters, if not years, because China is not going to abandon its way of life. Because the economy is run by stealing intellectual property and by subsidizing corporations. That's how China's business model, that's how their economy runs. They will not change that model, but Trump chose not to accept the balance of trade because of the increased purchase of agriculture from the United States. So now Trump cannot now acquiesce to China without looking like an idiot. And China is not going to change their ways. So we're at an impasse there. So I don't think a trade deal with China is coming anytime soon. I think it's more likely that Trump says to Mexico, hey, you know what? You're trying your best to stem the flow of immigrants. We will not impose any tariffs, or maybe if they do the 5%, they don't go to 10%. But again, if Trump is trying to, if Trump's, again, it's hard to get in his mind, but if in his mind, his primary goal isn't to balance the trade deficit, it's to rebuild America's manufacturing base, to have a manufacturing renaissance in the United States, then he's going to want to repeal all those things that NAFTA did to the United States. Remember Ross Perot and that giant sucking sound you'll hear of American jobs going, south of the border? Well, that's exactly what happened. It's much cheaper labor, and there's also subsidies in the Mexican economy. So if his ultimate goal is to get those GM parts manufacturers back into the United States, then tariffs on Mexico will be enacted and be increased. But you know what, Dave? That's why I have a model here that models the economic activity. I have a 20-point model that models economic growth for 10 points, and there's 10 points for inflation deflation dynamics. So if you understand and can recognize the data and math behind these indicators, then you don't have to so much guess what's going to happen. You could follow the data. There's predictive components, and then there's confirming components in this model. And this way you could try to be on the right side of the trade. I mean, to be specific, do you want to own bonds right now? The answer is yes. A lot of people, and I even wrote a book called The Coming Bond Market Collapse. I believe the bond market will absolutely implode in the near future, in the next 2 or 3 years. But you have to understand the dynamics behind that to occur. So for the bond market for bond prices to implode, meaning crash, and yields to skyrocket, you're going to need the money multiplier on M2 to skyrocket. For that to happen, you're going to need things like modern monetary theory, universal basic income. You need to go around and circumnavigate the banking system and send cash directly to people. That's all coming in the wake of the next recession. It's just not going to happen now. So now you want to own bond and bond proxies. You want to own some physical gold. Those things are working very well in the portfolio right now, as opposed to just, being short the dollar and long China or European stocks or, South American stocks, which are not working out well at all.
Well, I wanted to get your take on what the Fed has been doing and what Trump has been doing. I mean, Trump, when he came into office, the Fed was raising rates, and they said they were going to raise rates, 3-4 times during 2019. Trump said, you shouldn't be raising rates. You shouldn't be raising rates. And all of a sudden the Fed said, something, we're not going to raise rates in 2019. Now Trump is saying, listen, the Fed should really cut rates. They should really ramp up stimulus. And now we're hearing from Powell that they might be cutting rates. They might be pushing stimulus once again. I mean, is he controlling the Fed? Because it seems like every time he tweets out, they're doing exactly what he wants.
Okay, so let's go back to candidate Trump, Dave. Candidate Trump was complaining to the Federal Reserve and to then Chair Janet Yellen, that they were fomenting a huge bubble in the stock market and keeping President Obama happy, right? That was his mantra back when he was a candidate.
Right.
Now that he's actually in charge, he's turned the table 180 degrees. Now he's saying that we need to not only cut rates, but we need to go back into QE. So what caused this dramatic change in the Fed? Not so much what Donald Trump is saying. Remember back in the fall of 2018, there wasn't one high yield junk bond issued for 41 days. So the junk bond market completely froze. And when you have $1.5 trillion around, $1.5 trillion in junk bonds outstanding, and that's not including the $1 trillion, 1.2 trillion in leveraged loans that are outstanding. So if you can't refinance your debt, and by the way, about 25% of the Russell 2000, Dave, are zombie companies. In other words, they don't have enough earnings before interest and taxes to pay the interest on the debt that they have outstanding. So when you can no longer borrow and refinance your debt and service your debt, then these companies were on the threshold of going out of business. The Fed knows this. They know they created a monster. I mean, after all, they were at 0%, virtually 0%, 1% or below, 1%, 0 to 1%, for almost 9 years. Now, remember back in 2003 to 2004, they were at 1% for one darn year. And that helped propel the housing bubble. What do you think? What kind of misallocations of capital, what kind of massive imbalances do you think they created by staying at zero, virtually zero, for 9 years? Well, one of those bubbles is the bubble in the corporate bond market. A massive bubble that reached $9 trillion, up 40% since 2008. So they understand this. They're not dumb people. All their models don't work. And they're really, in that regard, they are, ignorant in the fact they're worried about inflation coming from engendering from people working. But the Fed understands they created this massive bubble in corporate debt. When the corporate bond market shut down, they had to stop their trajectory towards going to 3.5%. Don't forget, Powell, private equity Powell, he used to be in private equity, understands that when the Fed funds rate was 2.25 to 2.5, and they raised that in December, and they said that they could go to 3.5, and that the balance sheet was still going to be on autopilot, boy, you understood why the market dropped. Russell 2000 dropped 30% in a matter of a few weeks, and that's why the Fed is changing their mind. I don't think Donald Trump is directly influencing the Fed. I really don't.
So do you think they're going to be cutting rates this year?
I do. I think they will be cutting rates this year. I think that and here's why, Dave. And I don't want to get too much in the wonky weeds here, but when you have the money market, and the money market basically is the intra-bank lending rate. This is where the shadow banks borrow from the primary dealers. All the overnight funding occurs in the Fed funds market. Okay, in the Fed funds money market. That rate. That effective Fed funds rate is basically 2.4%. Make it easy, 2.4%. So if you're and the 10-year note is at was it today about 2.1%? It's called 2.1%. So if you're borrowing at 2.4% to invest in longer dated assets that are yielding 2.1%, that's called negative carry. That means you can go bankrupt. You can't make it up on volume. So the lending from shadow banks, the assets they buy is more geared towards that 10-year note and LIBOR. But the funding costs are controlled by the Fed. And when the funding costs are above or at least close to where your assets are being purchased, the money markets get clogged up. Nobody lends money. And when the money supply gets clogged up and you don't increase debts and loans outstanding, and when you have a debt-based fiat currency system, the bubbles that exist that count on new money, the bubbles being primarily, to a tertiary degree, real estate, but secondarily stock market and primarily in fixed income, when the fuel for those bubbles gets cut off, then you're going to have a depression. And I say like we've never seen before, not because I'm being hyperbolic, it's because the stock market, as a percentage of the underlying economy, really has never been higher. It's about 140% of underlying GDP today. The average of that ratio should be about 60%. So when the stock market is almost 1.5 times the underlying economy. When the stock market crumbles, it brings the economy down with it. So, for example, in 1987, you could have a stock market crater by 23%, as it did on that one Black Monday in October, and you're not going to have a recession because the stock market at that time was a very small percentage of GDP. I think it was like 30 or 40% of the economy. But when it's 140 or then it takes down the entire economy. And I could say the same thing about bonds. Total household net worth as a percentage of GDP is also at a record. So you include equity prices, bond prices, and real estate. It's 535% of the economy. That has never been higher. So basically, asset prices and the economy are the same thing. So when you see the high yield market shut down, and when you see stock prices crater, that's why the Fed panics, because they created this massive Frankenstein monster, and they don't know what the hell to do with it. I mean, if they try to they tried to normalize the balance sheet, and they tried to normalize interest rates. They raised rates 9 times, drained about $600 billion from the $4.5 trillion monster balance sheet that it created, and the world fell apart in December of 2018, not too long ago. That's why they're panicking. And guess what? The yield curve is still inverted. You asked me if I think the yield curve. You asked me if I thought the Fed would cut rates later this year. They have to. That inversion between Fed funds and the 10-year note is death for the economy. And if it lasts another few months, they will be forced to cut, even if, despite the fact that Trump wants them to do it already.
So you've been talking about, us entering negative interest rates. Last time you were on, we were talking about this. I mean, do you think the Fed is going to move into negative interest rates? Are they going to have to move it down that far?
I think in the wake of the next recession, Dave, in fact, Powell even said this very recently that, hey, investors, be on guard, Wall Street. We should stop using the term, extraordinary measures when it comes to the zero bound, because that was not a one-time fluke. That is something that we're going to have to return to and go back to many times. He hopes it won't be many times, but it's going to be many times. But when you go to zero, from 2.25 to 2.5, basically the effective Fed funds rate, like I said, is 2.4. When you go from 2.4% to zero, that's not a big move. It normally takes 500 basis points to get the economy out of a recession. The last recession, we reduced rates by 525 basis points, and we had 3 rounds of QE. In other words, the Fed printed or counterfeited, whichever term you want to use, $3.7 trillion worth of funding money, of the base money supply, Fed credit, which is the same as cash. So when they go back from when the economy enters into a recession, which we're very close to, if you look at a lot of the data outstanding, it's not only the PMIs in the United States, it's PMIs around the world. The ADP report came out last week. There's only 27,000 jobs created. The household survey and the non-farm payroll report put out by the Bureau of Labor Statistics was negative for many, many months leading up to that 27,000 print on ADP. So we're very close to a recession. So the Fed is going to, when this recession becomes manifest, taking interest rates from 2.25 or 2.4 to zero isn't going to be enough. They're going to have to go to negative interest rates. They're going to have to go to universal basic income, and they're going to have to go to modern monetary theory, which is basically just printing money. It's a form of helicopter money. And we don't have to borrow money when we have modern monetary theorists running around. We could just print the money and send it to people. No, we don't. Why worry about that accounting exercise of offsetting it with a debt? That's where we're headed. By the way, I want to say something. Negative interest rates did not work in Europe. They have a minus deposit rate of 40 basis points. It didn't work in Europe. So, I mean, what I'm trying to say in Europe is many parts of Europe in a recession, along with Brazil and South Korea and Japan, they're contracting economies. So, 0% interest rates are not a panacea. by any means for economic activity and economic growth. They really work very well for the stock market for a time, but they really are not a panacea to engender viable and long-lasting, healthy economic growth. In fact, they're probably the antidote to it.
So if we move in that direction where they're going to negative interest rates and universal basic income, I mean, this is no longer an open free market. This is completely controlled by the Fed.
But Dave, haven't we been there? I mean,
yes,
we started down that road. We started down that road in 1987 with the stock market crash. Then we amped it up in when we had the 1998 Russian ruble and the long-term capital. Then the 2000 NASDAQ bubble, and then the 2007, 2008, 2009 real estate crash. I mean, there isn't really a free market left anywhere in the world. I mean, let's look at Japan for a second, just briefly. Japan, where 50% of the entire bond market is owned by the Japanese central bank, the Bank of Japan. 50% of every bond outstanding, and there's a quadrillion yen worth of bonds outstanding. They own 80% of the entire ETF market, Dave. So where is the free market any longer? The ECB still has a negative deposit rate. QE is still going strong in Japan. The United States, same. It's a little bit better than the other countries because we did manage to get off 0%. But how much better off are we really? We drained the balance sheet from $4.5 trillion to $3.9 trillion, and that's it. We have to stop because that. In other words, central banks around the world have completely monetized $14 trillion worth of assets worldwide. Monetized, just that, counterfeited. They printed the money out of nothing, sent it to the economy, and then told you that we're never going to take that money back. Ever. Not temporarily. We didn't temporarily counterfeit and monetize the debt. We permanently sent an infusion of $14 trillion worth of base money, never again to take it out. And the ramifications of that, although most of that money is sequestered in the financial markets right now, the other consequences to that is that money that's permanently monetized was used to take interest rates to 0% around the planet. And that's why what do you do? What do you do when interest rates are 0%? You borrow a hell of a lot of money. And that's why we have 5.4 in the United States, $5.4 trillion worth of leveraged loans, junk bonds, and triple B debt. Triple B, which is one notch above junk. 5.4 trillion. Hey, Dave, the subprime mortgage crisis, that caused the whole world to fall apart? Right. That amount of debt was 1.5 trillion at its peak. So we're at 5.4 trillion, and that's just the junk bond market. And the junk bond and leverage, junk bond, I consider a lot of that triple B debt is really junk. That's scary. That should scare the hell out of you.
It scares me. It should scare everyone. And what the Fed is doing right now, they're actually kind of backing themselves into a corner because Trump and other leaders, they could turn around and say, listen, we've had the central banks running our economy. We had the central bank trying to increase the economy in the way they thought it should go. And now you've destroyed the economy. Everyone could, the way I'm looking at it, it looks like the central bank is completely exposed to all this and they have no way out of this.
Well, their job used to be in 1913, when the Federal Reserve was enacted, it used to be to tinker around the edges of the money market. So if a bank was in trouble, they could borrow money at the discount window at a penalty rate. Okay, only when a bank was in trouble. So, but now you have the Central Bank of the United States, coming out and telling you virtually, we are slaves to the stock market and the bond market. Yeah. Powell said it the other day, Dave. He said, we will do whatever it takes to make sure there's never another recession. Make sure that there's never another uptick on unemployment. That's not the way markets function, Dave. That's the beauty of markets. They cleanse and purge themselves. They're cathartic in nature. Not everything human beings do is perfect. And when we build massive imbalances in the economy, those businesses, those decisions should fail. China, by the way, you look at the consequences of taking interest rates to 0%. China's debt has quadrupled since 2007. Their household debt is up over 700% since 2008. You don't think there's any imbalances that were created from this massive misallocation of capital, borrowing money from the government of China? The government of China pushes the People's Bank of China, pushes debt to state-owned banks, and the state-owned banks push that debt onto state-owned enterprises. It's all, state-directed hole digging and filling in China.
So do you think that day of reckoning where we're going to have a purge, a recession or a depression, do you think that day is coming?
Well, it's coming, and it's coming fast. It's massively overdue. And every time the market tries to manifest that crash, try to heal, the recession, again, it's a healing mechanism. It tried to heal itself in 2007. It tried to say, hey, you're creating too many damn houses. People are spending too much money boosting consumption by taking home equity out of their house. We need to correct home prices because they're over 4.2 times incomes. Well, now they're 3.7 times incomes. And we took all that bad debt and we took it from the banks and put it on the public's balance sheet. But we didn't solve anything. The market has not been allowed to function correctly. The consequence of taking all that debt and putting it on the public, yes, there is a consequence. It's artificial interest rates for which there is no easy escape. Don't forget, like I said, the Fed tried to raise rates. They raised rates 9 times, burned $600 billion of base money, took it into the incinerator. And by the way, because of QE that was in effect, that gave an effective real interest rate of minus 300 basis points, according to many analysts, minus 300 basis points. You reverse that and you add the 9 rate hikes, so it's 2.25 to 3, plus we're in QT right now. So basically, quantitative tightening, in other words, they're drained $600 billion. We're still burning cash every month, although that's attenuating down to a trickle. In October, it's supposed to end. But you've kind of raised rates about, according to my calculations, between 500 and 600 basis points, or 5 to 6% since their lows of 2016, 2017. That means the Fed has already over-tightened. That's why the yield curve's inverting. That's why they were going to have another recession. And because asset prices are so out of whack with the underlying economy, you're not going to have a regular run-of-the-mill recession. You're going to have a depression. And I want to tell you that earnings per share on the S&P 500, I have to laugh, Dave. I keep hearing people say, the market's cheap because we used to value it on trailing 12-month earnings. Mm-hmm. Then it became future earnings of, what's the earnings going to be at the end of the year. Now we're going out 2 years. So now I'm hearing that the market's cheap based on 2020 earnings. Well, why don't we value the market based on 2030 earnings? It's probably trading 5 times 2030 earnings. So who cares? But here's the point. During a recession like we had in 2008, earnings dropped by 80%. Okay, so you can't come on television and say, well, I think the stock market's cheap because it's only trading at 17 times 2020 earnings. You have no damn idea what 2020 earnings are going to be. And if I'm right about a recession, and certainly the yield curve agrees with me, we definitely have the slowing economy that I've been predicting is already here. It's getting worse. We could have a recession. We could already be in a recession now because the NBER, National Bureau of Economic Research, the official entity that declares a recession, does so many, many months after one begins.
Yes, they do.
So we could already be in one right now. In fact, we probably are. But if earnings per share, Dave, drop by 80%, what PE multiple do you want to slap on that one?
So from what you're seeing, the way I'm looking at it is that I know you said Trump is not really controlling the Fed, but I think he's trying to keep everything going for the 2020 election, because anyone that controls the economy to make the economy look good, and he's using, the stock market, the unemployment numbers, just like they've done in the past. I think he's using this to his benefit to get through the 2020 elections, to say, hey, look, the economy is really, really doing well, and everyone's looking at those numbers. And I think he's using it for that purpose, to get through the election so he can be elected once again. And then what happens after that, most likely, I'm thinking everything will start to fall apart.
Well, I mean, my opinion is that I don't give much credence to people. Or individuals. I'll say autocrats, dictators. So people say to me, well, Donald Trump is going to make sure the economy doesn't have any problems up until his election. They have emperor after emperor in China has tried to manipulate the economy. They have direct manipulations with their economy. The state is the economy in China, yet their market peaked in 2007. It's down 50%. I have faith in markets. I have faith in multiple millions of people deciding where prices should be and what they want to purchase, voting every day with their wallet what they want to buy and sell. That's who I have faith in. I don't believe that any one individual, even Donald Trump, can save us from what's happening. I really don't. And he doesn't have anywhere near the power of Xi Jinping. But if you look at it, put up a chart of the Shanghai Composite Index under Emperor Xi Jinping for the last, few years, and tell me if you think that one individual, one autocrat, can save the economy and the market from their eventual gravitational forces comprised of debt that needs to be defaulted upon. Massive insolvent debts that need to be reconciled.
I don't think they can save it, but they do a fine job kicking it down the road, though.
Well, maybe he can for a year. I wouldn't bet on it, though. Rather than saying Donald Trump is going to be able to save the economy for another year and a half, I would rather model the economy based on my 20 components. And I look at things like, here, let me just tell you the things that I look at. I look at major central bank monetary policies, real interest rates, which are effective Fed funds minus 10-year break-evens. I look at the value of the dollar. I look at inflation break-even spreads. I look at the velocity of M2. I look at the ISMs. I look at crude prices. I look at corporate debt as a percentage of GDP, the shape of the yield curve, high yield and LIBOR spreads. I mean, I can go on. These are the things that I have confidence in. I do not have confidence in any one individual.
So how do you think this is going to play out? We've been talking about recession, downturn. Is this going to be like 2008? Is that what you're talking about? Or
eventually it's going to be, this is how I think it's going to play out. So I run the models called the inflation, deflation, economic cycle model. The model has been telling me for quite some time now, and my clients can verify this, we've been in a disinflationary environment. So greatly beneficial in owning, the dollar, benefiting from those investments that would appreciate when the dollar appreciates. Oh, the Treasury market's been a great place for us. Muni bond market's been a great place for us. We were long the dollar before. We're now neutral on the dollar. We have a neutral dollar stance. Actually, physical gold, not the miners so much, but physical gold, not the miners, has done very well lately. But I think what's going to happen is that we're going to enter into that recession, which will quickly metastasize into a depression. And then on the other side of that, so you have a deflationary depression, and the other side of that, you're going to have things like we mentioned before, UBI, MMT, negative rates, the banning of cash. Then once that money multiplier really starts to kick in, you'll get your stagflation. And I predict we'll have several years of stagflation, very slow growth, and very, very high rates of inflation for many years until that's the real crash, until the whole system blows up. Then you'll have debt defaults and a reset of the currency. That's what I'm predicting. That's how. And I am not someone I'm not a Cassandra, and I don't use hyperbole. I'm just using math and data based on the fact that we now have $10 trillion worth of negative yielding sovereign debt, record high. Never had any more than this. Almost 11 trillion now of negative yielding sovereign debt. These conditions have never been manifest before. So when people look around and say, "Oh, things are great," don't you know the stock market's only about 6-7% off its highs, and isn't everything wonderful in the world? Well, no. We have never had this much debt outstanding, where our debt is now 330% of global GDP, never been that high. $250 trillion worth of debt outstanding. Almost 11 trillion of that is negative. And you have massive imbalances around the world. Japan, we talked about in a recession, massive amount of debt outstanding, contracting economy. Much of Europe is in the same condition. And all these central banks are addicted to 0% interest rates or lower. So it can't, and by the way, that has engendered, again, if I haven't made it clear already, that has engendered the massive worldwide bubble in fixed income, which is the primary bubble that exists today. It exists in sovereign debt and from every fixed income asset outstanding. So when you get that stagflation and that blows up fixed income, that's the real crash.
Michael, thank you very much for being on the X22 Report Spotlight. Once again, how can people see your work?
So you go to the website, it's pentoport.com, and we have a podcast there. It's free trial membership. It's only it's a little less than $50 a year for the podcast. There's written commentaries I put out occasionally every few weeks. If you have any questions about the portfolio, please email me at mpento@pentoport.com, or you can even call the office here. Someone will answer the phone, 732-772-9500. We promise if you call, we won't bite you.
Well, thank you very much for being on the Spotlight. I really appreciate it. Thank you very much.
Thank you, Dave.